I think so. Let's go for it. Bunzel has had a disaster of a week, and it's one of the reasons that my portfolio hasn't done that well. I did buy it on this dip, but I'd started buying it before a little bit. And I thought and thought, and I thought to myself, there's probably no reason to rush into this, and then went and rushed into it. But maybe I'll live to regret that. We will see. Stock is down 25%. It was down 25% in a day, and this has caught the eye of a lot of people who don't pay much attention to Bunzel, but it's making me look stupid is the problem, because I've been saying beforehand, I think this is kind of good value here where it's at, and then it's gone and got absolutely clattered. But Q1 update is not good. We can talk about how not good it is, but I think the only meaningful question here is how not good it is, not whether it's good. And what I will say, because I've forgotten to write it in my notes, and I will come back to this, is one of the things I was impressed by is that management said this is not good. Q1, as I see it for the UK, there's been a lot of retail earnings that I think have been outright bad. You might think they're not terminal. You might think the stock price was an overreaction in a few cases, if you include things like Greggs or B&M Value and so on and so forth. You can tell me the stock price is an overreaction. I wouldn't necessarily disagree. You can't, I don't think, without retracting some form of disagreement from me, tell me that you think these were not bad results, because they were. And Bunzel hasn't attempted to hide the fact that its results are disappointing. CEO used the word disappointing itself. Often you find kind of headlines saying B&M's is a good one for this, of here's the size of the buyback, ignoring the fact that it's down quite a bit. None of that from Bunzel. This is bad. Let's get to it. Anyway, revenues then were in constant currency up 2.6%. That's not a big number. It's about inflation probably at the moment, might be a fraction under that. But anyway, that was all driven by acquisitions anyway. So underlying revenues were down 1%, partly as a result of a pricing strategy, partly as a result of some price deflation, which is less of a worry in the sense that these are costs that they sort of just pass through in various different ways. And when prices come down from suppliers, they generally lower them to customers, but it shows as revenues are lower and you see the profit line coming in fine. The profit line's not coming in fine this time, Steve. They've said underlying margin was down. They didn't say how much, but they said significant. And they are guiding for, in the first half of the year, so the quarter we've just had and the one that we're, now in, about 7% in operating margin. That's down from 8.3% the year before, and they're guiding for this to get back to 8% by the end of the year. Doesn't sound like a lot. It's a percentage point. It's a 1% lower, but that amounts to a 15% swing in your operating income. So 15% lower operating income if things go as they're intending. As a result, they've paused their buyback. They were just over halfway through a £200 million buyback, and they are instead looking to strengthen their balance sheet to get their leverage ratio down. I don't think their leverage ratio is in danger stations at the moment. This is more slightly, I think, preemptive than anything else, but generally speaking, pausing a buyback is like cutting a dividend. It's never a good thing. And you've set out on a course that says you want to try and return cash to shareholders, and you're finding you're not able to do it, or you think it's not the right thing anymore. To some extent, that might be them doing the right thing, but it's not a positive thing that they're doing. So the real issues are in North America, which is their largest market. They've been trying to ramp their own branded products, so things they have manufacturers make for them and then ship out to people. They attempt to be a one-stop shop for things like, basically consumables that are not food. They've lost a key customer along the way. They were saying they didn't name that customer. In terms of an outlook, they cited tariffs in this guidance for 7% margin and some basically flat underlying revenue, and the rest of it driven by acquisitions. They cited tariffs as a risk here. 80% of their US stuff is sourced internally, so it's not that sort of a tariff risk for them. But I guess the concern is inflation and therefore recession, and that is a risk for Bunzel. Big question then, is 25% an overreaction? And I think the answer is probably yes. They said 874 million last year in free cash flow. Lose 15% of that, which is what you're kind of looking at here, takes you to 742 million, takes you to 13 times free cash flow with the current market cap of it being down 25%. I suspect this may sort itself out. They are taking action in their US division to try and, basically fire people and get different people in to try and turn this around quickly. We can say a bit more about it along the way, but I do think this is an overreaction here, Steve. Do you think anything about this?
Just give me that free cash flow figure again, Steve.
What I read for 2024 was 874. Lose 15% takes you to 742.
Well, that would only be 10 times free cash flow, I think. So currently the market cap is 7.5 billion according to Google. So it's even cheaper than you thought. I'm not sure if you want to just double check that market cap figures. Maybe Google's got it wrong, but I thought I saw on the LSE of a kind of similar number as well. So I mean, we're back to sometimes, Steve, we laugh about these things because something falls down 25% and everyone has a fit, and we say back to prices not seen since 2 days ago. Do you know what I mean, or something like that, or last week? But this one is genuinely back to prices not seen since about 8, maybe 9 years ago. So it's a fair old run back in price. So this is a genuine fall. And when you told me about it, Steve, and you gave me some information on the on WhatsApp about it, my thoughts were this must be a buy for you. Then this seems to be somewhat of an overreaction. But yes, you can see why the market's been spooked, Steve, because yes, there's that 15%, which you could then say, like, well, let's just transcribe that straight to a 15% fall in the share price. Also, the pausing of the buyback isn't a particularly healthy thing to keeping your share price the same. But also in this report, there's they've noted that in the UK and Ireland, they didn't do very well. In North America, they also didn't do that well, and now it's very uncertain there. And operating margin declines in continental Europe. Actually, they did very well in Latin America, which is a particular growth vehicle for them at the moment. So this, you can sort of see the reasons why it's fallen that far, Steve. But obviously, you've got keener eyes on the business than the vast majority of these. I would assume. So, yeah, I don't know, Steve. I don't think it's a massive issue. I quite like the look of it here myself. But whether I would buy it or not, I'm not sure if it fits my portfolio that well. But I think it definitely fits yours. So when does it? When do you start to fill your boots, Steve?
It's a good question, isn't it? I mean, I made a start in the week, and I imagine there'll be more to come with this one. My sense was that you don't need to be in a rush with this, in that I don't see an obvious reason that this is going to suddenly snap back. I mean, tariff news might do anything at any point, to be honest, and they have mentioned tariffs as a potential, as a source of uncertainty. I didn't quite pin down what they were after like that. As I say, a lot of their US stuff is sourced from within the US, so it's not as straightforward as we've got stuff landing that we now can't. We now have to pay however much more to unpack from the shipping container. I think one of the things to sort of wind this up a little bit is that we're likely to see over the next however many weeks and months, especially in US earnings season, is that I think we're going to see quite a few businesses that are problems of their own making, or problems that are not to do with tariffs, start trying to hide those problems behind tariffs. And I don't necessarily think that's the case with Bunzel. I mean, they do have problems. Those problems are of their own making a bit. But I think these might clear up quicker than people might think. I was looking with some of the chat on the Trading 212 forum. Samantha L, who, whatever I agree or disagree with her takes on various different things, she's clearly a very thoughtful person and one of the better contributors on there. I don't think she's right about everything, but I don't think anyone's right about everything. That's far too high a standard to hold someone to. So when I say I'm not sure I agree with her take on Bunzel here, that's not an insult, and it's not in any way meant to imply that I don't think she's, as I say, one of the most interesting and insightful contributors to that forum to listen to. She thinks this is going to take time to turn around. What you've seen is margins come under pressure, a buyback paused, and some volatility there. It's an interesting one where they're guiding for margins to sort of make their way back by the end of the year, and they think some of it will take its way into 2026 as well. I'm inclined towards trusting this management, partly because I think they have shot straight with us about the situation at the moment. It feels like to compare it to some other things, it feels a bit like a Vistry situation where both of us were kind of, to an extent, impressed at the fact that Vistry were fairly clear and fairly forthright and fairly rapid response in pointing out that and noting that they had a problem. They happen in businesses, not good that they have them, but they are minded towards fronting up and dealing with it. I think Bunzel might be similar, and I think these. Yeah, I'm minded to buy this and see. To be honest, Steve.
FTSE is one of those weird sort of indexes where the worst performers one year often seem to be the best performers the next. So it would be interesting to see if the market kind of throws us a bit of shade all year and then realises at the end of it that actually Bunzel's kind of started to rectify the issues, and then 2026 ends up being one of those years where it's one of the best performing stocks in the index. So it'd be interesting to see how that plays out. But yeah, like you, Steve, I'm not overly concerned here. In the report, there's a lot of kind of how we're going to address this, but also that the business model, is unchanged and supported by this focus on improving their offering, constantly improving their offering for customers. So my only thing that I'm not overly keen on is that pausing of the buyback. I just think that adds to the panic rather than takes away from it. This is the point where you really want Bunzl to turn around and say, look, we're going to carry on, finish that buyback. It's not a massive amount of money left on the table. And it's not like, I mean, they're saying that to conserve cash is the reason they're doing it, but Bunzel's not a business that couldn't go out and get debt if it needed to. So I'm not overly convinced by that as an argument. I would have preferred to see that play out, and have obviously a lot more effect, because it's basically like buying 25% extra shares back for your money. But yeah, so I feel like that's my only real shame there. But yeah, like you, Steve, I think we've covered these enough to know that they've not done anything so far to make us say that this is a weak management team or anything like that. So yeah, I think benefit of the doubt for now, Steve.
It's a fun kind of paradox of buybacks, isn't it? That directly you announce you're going to stop them, they suddenly become more attractive than they were sort of 10 minutes earlier. But we'll see what they make of it. I also sort of wonder, I mean, just the equation of working down your debt against buying back your stock. It may have made sense to strengthen your balance sheet when the share price was about 30% higher than it currently is. I don't know if it does anymore, but that's them playing the scene as they see it in front of them, I guess. We will see how all that develops. Worth noting that a couple of other FTSE 100 distributors also kind of got a little bit of hit from Bunzel's report as well. So there was Diploma that was sort of in the blast radius of that and fell a little bit on the day too, which is be interesting to see how they come through. I thought their last report was kind of disappointing. So we will no doubt have that relatively soon. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.